Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Scott Nations, president of Nations Indexes, and Mark Sebastian, COO of Option Pit. We're here to discuss the spread between mega cap stocks and the rest of the market. It's great to see you guys as always. And Mark, that really is the story, at least what we're seeing for today. And I can't even discern, fundamentally what happened from this morning, to the move that we've seen later in the session. Seems as if it's the mega caps versus the rest of the market.
Yeah, I think what triggered it was S&P futures moved over 5,500, but really it's being triggered by the mega caps. They are just swallowing all of the air in the market. Apple, Nvidia, Microsoft, and then, kind of a rotating taste of Broadcom, Google, Amazon, and a little bit of Tesla. It's been really interesting, but it's not pulling. This is not a case of a rising tide lifting all ships. RSP, which is the equal weighted S&P 500, is down about 3% month over month. QQQE, which is the equal weighted triple Q, month over month just went positive today. So it's not been a particularly strong overall market, but in those six names, if you're long them, you're continuing to love this market.
Yeah, and Scott, you point out an interesting spread. You're seeing the VIX just at about 12.5 now, but VSTOXX, the VIX of Europe, is near 20. And to your point, that's a massive spread. So you have to think to yourself, what needs to happen? I mean, does something need to happen in Europe, or do we see a pop in the VIX?
Well, I think here volatility has gotten way too low. It's gotten really low, which normally is fine. But when the market does this, that is when breadth is horrible, when gains are very concentrated, as Mark pointed out, and implied volatility gets very low, that's a recipe for some sort of disturbance that doesn't work out very well. An example recently would be Volmageddon, when we had several months where markets were very quiet and volatility was very low, and then all of a sudden it wasn't. And we know that that's kind of the way markets work. I think something interesting is that over the past few months, actually a little bit less than that, we saw people bidding up call prices. And then a couple of weeks ago, they just gave up on that. They quit buying out of the money calls in the S&P. They just gave up on it entirely. And that is back. Part of the problem, and Mark pointed this out, is that breadth is horrible. So that's bad for the market. S&P is up over 14% year to date, but the equal weight S&P is up less than 4%. And the Russell is lower, or at least this morning was a tiny bit lower on the year, which indicates, as Mark pointed out, that the gains so far are really concentrated. Volatility is, again, very low. Voldex got below 10 last week. Taildex, which is the cost of deep out-of-the-money puts or crash protection in the S&P, got below 7 last week. That's just too low. And as an old trader, we used to say, buy options when you can, not when you have to.
Right. And they seem to be cheap right now. But Scott, we were talking about this earlier in June. It feels as if traders are expecting a quiet summer. And that kind of under the surface, that means something may be happening if everyone is exercising some sort of complacency or thinking about, we'll take the summer off.
Yeah, right. When everybody's leaning in the same direction, we know that is generally not good for the market. The market returns, they're not normal. They have fat tails, meaning to the downside. We have bigger and more often extreme moves than you would expect. And this is just a time when everything seems so perfect that you don't have to be a pessimist to wonder, boy, is there something going on?
Yeah. So Mark, is there an actual trade here then?
Yeah, there's with vol low and interest rates still high. One of the things people don't realize, interest rates increase the value of calls, decrease the value of puts. If you're nervous about the market right now, with skew low, I'm looking at SDEX. It's relatively low. That's the skew index. That's going to kind of tell you the 25 delta call versus the 25 delta put. So a reasonable call and a reasonable put, how they trade off of each other. With interest rates higher and vol low, I can buy a put and sell a call that are equally spread from where the market is currently trading. And I can take in a pretty nice credit on that to protect myself. It's called a collar, and using in this market where we're at all-time highs, but things are really narrow. And Scott laid out all of the things that tell us, hey, we could see a quick turn the other way. It makes a lot of sense to put on a collar and actually put some money in your pocket because interest rates are high and that skew is so low.
Right. Well, Scott, I mean, the pop in the V stocks, do you think that's perhaps a result of what, is happening with EU politics and most recently what's happening with France? Do you think perhaps that the US election volatility isn't being priced into the market yet, or perhaps futures indicate something else?
No, I think almost nothing is being implied by option prices. That is, there's no catalyst on the horizon, whether it's elections or Fed rate increases or the lack of Fed rate increases. V stocks, given that it focuses on European names, is just going to be a little bit different animal. I do say it's never a good thing when investors start to worry about geopolitics, which is kind of what's going on right now with V stocks. It's never good when they have to start looking at a map to find out where the geopolitical hotspot is. And V stocks, I think, is really working on a very different timetable set of scenarios than VIX is.
Yeah, well, I think that's an interesting point that Scott brings up, Mark, because regardless of what's happening with geopolitics, and we've seen this looking at, historical performance during election years in the US, the fundamentals of companies perhaps aren't going to necessarily change. You're investing in the company, not necessarily the country.
Well, yeah, but this is all kind of coming out of France. France is the second largest economy in the European Union, and their bonds are getting destroyed. There's political worries. We start seeing things get kind of expand into like Germany. There is a correlation between our economies. When Europe gets soft, that will invariably spill over to the United States. V stocks and VIX do not trade in lockstep, but the spread between V stocks and the VIX right now is the widest it's been in 2 years. And the fact that the United States and US markets are just completely ignoring what is going on over there kind of surprises me. I do think there is some spillover risk, especially when you look at what started this, which is France's debt load, and what is going on here in the United States and our debt load. And, I keep looking at the market and saying, what could cause this thing to break? And the answer is these major names stop going up. They don't even have to go down, but they stop going up, and we get an interest rate spike. And we see what an interest rate spike is doing in France. We get something similar to here. Markets could get very ugly very quickly.
Yeah, and Scott, to Mark's point, even if they're not going down, but they're not going up, I mean, earnings season, whether it's remainder 2024, but I also think looking into 2025, these companies are going to need to start to justify their multiples. Because of course, the obvious question is, has the AI story ran ahead of itself? Do people perhaps overspend, right, with CapEx as regarding that? So, I mean, all these things are going to have to come together from a fundamental perspective for these companies, at least, not to go down, but the fact that they're not going anywhere.
Right. And I'm not certain AI is into a bubble situation yet. But I do think what we see is a lot of investors are just closing their eyes and buying some of these AI names because they think that they have to. Probably not quite as bad as 1999 yet, but it's not that far away. And I think that the real danger in the sort of narrowness of the rally that we've discussed is that if something unfortunate happens, whether it's geopolitical or economic or financial, traders and investors have big profits in the Mag 7 names. And those might be the names that they decide to sell first for several reasons. One, they want to protect those profits. And two, they're going to say these are big names. They should be really liquid. And so those names could really, really take it on the chin if investor sentiment turns.
Yeah, so Mark, it sounds more like it's about positioning, versus an actual fundamental issue with the company. I mean, you're going to have to take profits from somewhere. So it might be more, an effect of that versus something that's idiosyncratic to these types of companies.
Yeah, I mean, I think they're being viewed as a flight to safety when, in fact, this last leg up probably makes them a little more dangerous than people realize. And there's a lot more risk. The move Apple has made, it's based on the assumption that people are going to upgrade their phones because they want the new AI chatbot. the move NVIDIA that there's going to be a broadening of the use of artificial intelligence. Those data centers are going to continue to grow and grow and grow, and they're going to continue to hold those margins. But the money is so narrow, it's not going into even like the secondary names that are still good stocks. Look at AMD. Yes, it's still up on the year, but it hasn't done anything in months. Intel is just a dumpster fire. And you go across the board in these different segments, and you see the same thing over and over again. Everybody's just piling into the same stocks and leaving the rest behind. And I actually think that makes that flight to safety look a little less safe than maybe market participants want to know or hear about.
Yeah,
and Jill,
I'm sorry, go ahead, Scott.
Well, quickly, I also want to point, for the first time in a long time, the PE for the S&P is above 20. So there's no way in the world that you can say that the stock market in general is cheap or a value, or that would be the place to put money if just because it starts falling. Mark didn't mention Tesla. One thing I will say is that I am just stunned that the idea that Tesla is going to give Elon Musk another $48 billion worth of stock is bullish. I'm not certain how that's bullish, that you're going to dilute the stockholders by that much and it becomes bullish. Listen, he was going to be CEO of Tesla no matter what. And the fact that that investors are so in love with the idea of Elon, such that they think that owning the shares will make them best buddies, is a little bit crazy.
Yeah,
it kind of smells of Apple 15 years before
right,
Steve Jobs died.
And Mark,
really
you and I have written on this, in terms of the Apple and like the whole fanboy phenomenon, but God forbid Elon gets hit by a bus tomorrow. That totally changes the calculus in the investment thesis for people who are buying shares for that reason. But I also feel like when you have a media frenzy around Microsoft, Apple, and NVIDIA about, who's beating who in terms of the market cap race and, the $3 trillion magic number there. I mean, really, that's what we're reporting on. And, in terms of what, who's has a higher market cap in the morning session versus the afternoon session, that's when things start to feel a bit frothy. If that's the main news of the day.
It's like the stock market version of professional wrestling.
Yes, well, we'll leave it at that analogy. Appreciate the insight as always, guys. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.